If you're looking for some powerful compounding and growth in your dividend portfolio, one of the options that may come across your radar is Alphabet. Now, this is in the FastGraphs platform. You'll notice here that it's only just starting to pay a dividend now. And this, I think, is fairly normal for most high growth tech companies. They grow for a long time and eventually the growth begins to slow and the dividend payments begin to commence. And we've seen that as well recently with Meta and years ago also with Microsoft, for example. Now, if we turn to the Performance tab, it will just give a very quick overview of what's been going on. And one of the first things to note here is the very first dividend payment. That's a quarterly payment of 20 cents per share. Now, with a share price of $150, we're talking about a very small dividend payment here. But perhaps most importantly is this compounded average growth rate here of about 17% per annum over the last 10 years compared to the S&P 500. Now, of course, Google is a major company and it's a major component of the S&P 500 also. So take this with a grain of salt. It's a big part of the market there. Now, what I'm looking at here is the overall adjusted operating earnings, and if I take the price off the chart here and I'm just looking at this as an owner of a company, you can see that it's been growing the earnings here and across the bottom here 15, 17, 3%, etc, etc. Now there's obviously a bit of a bump here. I would say that's like a post-COVID bump, and if you sort of smooth it out and just assume that the earnings had been increasing over that period in a more linear fashion, you know, that's sort of what we see, and we see this beautiful upwards growth trajectory. Now, again, the growth rate has been good, and there's a very low dividend payment. So this is not a dividend-paying stock that is going to make you rich in any sense of the word very quickly. It's definitely a stock that you would need to hold for a very long period of time to gain from this stock, particularly when you think about the income from dividends. It's going to be very small overall, but eventually I believe it could turn into quite a strong compounder in terms of the dividends, but also quite a strong grower in terms of this overall earnings growth. Now let's have a look at some of the numbers here. The S&P credit rating is AA+, so a fantastic credit rating. Long-term debt to capital, it's got virtually no debt. These are elements I like to see. So in a nutshell, I would say this is a strong fortress. Now the company itself does have some challenges, and I'll talk through some of those challenges next. But here, if we put price on the chart, we can see that it fairly closely has followed that orange line there. So prices seem to be following the operating earnings. And if I switch this down to the sales, we sort of again see that prices have followed the sales line, although you'll note that the sales line has been smoother than the operating earnings. It doesn't have that sort of weird kink or bump in about 2021. At any time, in essence, where the price is below this orange line here for sales, it looks like a nice time to buy. Now, switching back to the operating earnings, I think if you look at this visually, you can see that the prices here in black follow that orange operating earnings better than it does the sales. So we see the prices accelerated here as operating earnings jumped. And then as operating earnings fell, we see again that the prices were falling down on this tranche as well. So what am I looking at then as I look forward? Now, one of the things to look at here, I think, is the analyst scorecard. Not too worried about the 1 year forward because, again, I'm going to be holding this for a long time and it's looking good. So I think generally the company manages to hit the analyst expectations and sometimes beats them on a 2 year forward basis. So let's switch over to the forecasting. Now, this is where I begin to look at the future and what the future may hold. There's a couple of key points here using FastGraphs. Number one, if you look at this panel down the bottom here, we can see 6 months ago the analyst estimates for 2024 were $6.80 of adjusted earnings. They're now up to $7.65. Now in the same sort of sense here for 2025, we can see again over the last 6 months the estimates have increased for earnings in 2025 and 2026, representing 13% growth and almost 16% growth now for 2026 being estimated. If the company can grow these earnings at this rate, we've seen that the price fairly well tracks that earnings, and so that is what we might expect prices to do. If prices follow that pattern, we would expect to see prices increasing at about these rates as well. Now I'm going to put the price back on the chart here. Now the orange line at the moment is being computed with the Graham-Dodd formula. The GDF here. And the fair value here then is suggested at 16.3. Now, if I think it's personally quite low, and we can see here from the blended PE as well at 21 times, the fair value ratio is quite low here. Now, what I normally do is I switch over to the normal multiple. I'm going to switch this multiple to quite a low multiple, so what it's exhibited over the last year, about a 21, 22 times multiple on price to earnings. And I think that should be very achievable moving forward, particularly with these types of growth rates. But if we do keep that multiple quite low here at a relatively undemanding 21.8, this means that we could expect from this price point here about an 18.4% total annualized rate of return, or by the end of 2026 a 47% increase in the value of the holding here in total. Now, there's a couple of points to make here. Number one, this is buying at this point in time. Now, obviously, there's been some concerns around the Alphabet stock here for Google, and certainly if you were buying at this elevated point, the potential earnings here would be relatively less. But here I'm looking at buying it below this blue line, and generally that seems to have been, in the last several years, a good sort of point to buy it. It was available here in early 2023, in the early 20s or just below the 20s. At the moment, available for about 21.5 times on a price to earnings ratio. Now, it's been a while since we held Alphabet in our portfolio. I have started a position in the last week, and I will continue to add to the position, I think, as long as the stock is below this blue line. Now, this is part of the growth tranche in our overall portfolio. It's not obviously here with very small dividend payout, dividend yield here of about 53%. It's not going to derive or drive current income. Instead, I'm looking for the overall long-term growth in the value of the company, and that I anticipate is going to drive the long-term dividend growth. Now, it's, I think, difficult for the analysts here to get a handle on what the dividend is going to look like several years down the track, simply because this is a relatively new dividend. Now, there's also elements here that we can pick up from the company filings and conference calls, which make me think that the dividend will grow quite a bit later on, and I will come back to those in a later video. Now, switching over to the FinChat platform. Now, one of the things I like about the FinChat platform is it allows us to look at the KPIs. Now, what I like to see here with the revenue sources for the company is I like to see what is happening here, which ones are trending upwards and in what way. Now, just a very quick look down here. Oops. When we chart them all, we can see that these blue bars here is the Google search and other revenue, and it is in essence dwarfing these other sources of revenue here. So these other sources of revenue are relatively minor, The search and other revenue is gigantic. And you can see this as well from the table at the bottom of the screen here. So in 2023, we're talking about 175 million compared to about 30 for the other sources of revenue. So what does this mean? Now I'm just going to toggle this on to a separate axis so it sort of brings it back in line so we can sort of see this trend. And we can see Google Cloud revenue. If we look at this compared to the other sources of revenue, I think this is the strongest grower over the last 6 years. And they're up against some pretty stiff competition in this area, but Google has demonstrated here with this revenue growth that they have the potential to grow the segment very strongly, I think, over the next several years. So it will be strong growth off this low base, but I think that's a good thing to see long term. YouTube ads revenue, this has not been growing very strongly, so I think we've got a big bump here in 2021 with some fairly relatively low growth after that, but it is still trending upwards, and that is good to see. The Google subscriptions, platforms and devices revenue, again, this is fairly strong, and it is more or less continuing to trend upwards, though at a relatively low pace. The Google network revenue here is, to be honest, rather lackluster. So you can see that it sort of peaked up here after the pandemic and now seems to be on a slight decrease as the company changes. Now, putting all this into perspective on the same axis again, we see here the Google search. Now, this is both a strength and, I would say, a weakness for Google. Now, the very fact that this dwarfs these other sources of revenue means that they're very, very reliant on this. Now, of course, when you're thinking about Google search, the big question is, can they maintain this dominance and this market share in terms of the search market? And then from this, can they continue to derive such strong revenue? Now, the next couple of years will be choppy. There is no doubt about it. It could be that we will see the revenue growth in this segment begin to soften. I anticipate that we will see that as, for example, OpenAI releases their search ChatGPT functions. Perplexity begins to bite into what's going on here as well with live search, data-driven search, and generative AI making sense of all that for us. I mean, personally, I'm not a huge fan of some of the recent changes in the Google search. So, for example, I'm seeing more Reddit answers popping up, which isn't always what I want to see. So I think Google is, shall we say, thrashing around and experimenting and trying to find what works. I think as an investor, one of the biggest challenges they have in the segment is to keep this alive and to continue to grow it. They will, need to experiment. Now, Google or Alphabet is by nature a very experimental company, and I think they'll continue to experiment really well. And the challenge here might be that to compete with other vendors such as OpenAI or Perplexity in the search space, to continue to combat and compete with these other competitors, they may need to do something or make some changes or to their product or the business model here, which would cannibalize their own search revenue in this space. Now that always becomes a very difficult proposition for an incumbent in a competitive marketplace, for them to put in place a plan that will cannibalize or sort of steal some of the search revenue as they release or develop new products potentially. And I think that will be the biggest challenge that they have, is protecting this revenue, not even necessarily continuing to grow it, but maybe even protecting it, keeping it steady in the face of stiff competition. And then over time, I would expect to see, for example, the Google Cloud revenue continue to increase and become a larger part of their overall revenue mix. And that, in my mind, would also diversify the platform here where they're deriving their revenue from. So overall, it's not a slam dunk. It's a company here where I think we're going to see some increasing volatility in the prices. But ultimately, this is what I'm looking at is long-term earnings growth, which I do think the company will continue to achieve. You'll see that the company is followed by about 59 analysts here giving estimates for the earnings for the end of 2025. So it's well followed. The industry is well understood, and I am absolutely confident that all the analysts are going to be looking at, the difference here in revenue, the amount of revenue coming here from Google search, and really beginning to dig into the implications for this company. And the analysts seem to believe, as I do, that Google or Alphabet is going to be able to maintain a high level of revenue here. Now, it doesn't necessarily mean a continued dominance or almost a monopoly in the search space in the revenue here, but certainly this is a company that's good at experimenting, it's good at changes, it's good at assessing what works, and ultimately that's baked into their DNA, and I suspect and strongly suspect that they'll continue to follow that same playbook of experimentation and change, and that will help them to drive the continued earnings growth into the future. Now, 15%, it's not massive, but compound that out over several years, buying in at around 20 times PE, and I think we are in a good position with taking an entry at this price and throwing into the mix there the dividends that are starting to pay out, and I suspect over time we'll see that increase as well. So this is one of the tranches, as I said, where I'm looking for long-term growth here, very long-term growth in the dividends, and again, intending to hold this for a very, very long period of time, and looking to grow this dividend income and compound the dividend income with time as a company continues to grow.